3, 2, 1.
Alrighty,
Welcome to the show.
here we are. Man, it's been one heck of a volatile week.
I know.
Lots of news.
Make it stop.
I wish we could make it stop. Actually, so it's Thursday night after the close. Thursday was one of the biggest down days. S&P closed down about 1.25% today, but it had gapped up in the morning, like way up. So it did this huge engulfing candle day, took out all the gains from yesterday, actually gapped up this morning above both the 50-day and the 20-day moving average lines. But pretty quickly thereafter reversed and was way down on the day. And it's Thursday, so tomorrow is the Fed's comments, whatever Powell's going to say about from Jackson Hole. They've been talking about it in financial media for a couple of weeks, how important this Jackson Hole meeting, this is an annual symposium that they do. It's going to be interesting to see what happens tomorrow. It could be set up for another big down day, and that would take out some pretty important support levels, but we shall see. It might go the other way. I don't know. I don't have a crystal ball.
Who knows?
All right. TSP Weekly Podcast, 27 August 2023. So we got a question we're going to take a look at, and we're going to talk about it in terms of whipsaw and moving averages. And then we're going to take a look at basically 5 different strategies that you can use to manage your TSP account. So we use a trend trading methodology. There are basically 5. There might be more, but there's basically 5 that I would say most people kind of look at. And the bottom line up front of that is basically pick a strategy and get good at it and stick with it. And we'll take a look at the bonus chart is the dollar versus the iFund. We've done this before, but the dollar right now is the most important chart you can look at, I think. And then the weekly TSP fund charts. So I've learned a lot from you guys over the last 9 months since I became a member, so I really appreciate that. The one item I think would be helpful to me and probably others for you to cover in the near future is why your stack of indicators don't seem sensitive enough to catch the smaller ups and downs. You often say you don't want to be whipsawed back and forth in the stock funds, but at the same time, I don't think you ever use the allowable 2 moves into the stocks in a month. Seems like you might be able to come up with a more sensitive stack of indicators, which might generate more gains. Just my thoughts. Take care. Really good question. In stockcharts.com, if you go to the indicator tab, there are 50 indicators in there. So I built this stack, which gives me basically an 80% solution to making reallocation decisions. If you use, we're going to look at moving average lines specifically here, but you can see it the best in moving averages. If you use a shorter moving average, you're going to get more reallocations. If you use a longer term moving average, you're going to get fewer reallocations. So what we're constantly trying to balance is the moving average line that will give you the most support when the market's going up, or resistance when the market's going down. That can help us to minimize the number of reallocations that we do, but also minimize the amount of drawdown that you have to take to get to the decision point. And the stack that I use is, it's not the only one. People like Bollinger Bands and Money Flow Index and all these other tools that are available. But these are the ones that I found that are as sensitive as I can get it to keep from getting whipsawed in and out of the market.
Yeah, and so you're balancing all those things, right?
Yep.
That's the one thing to remember. And it's still not always, it's not the 100% solution. 80-20 sounds good, but really, there's a lot going on in that other 20%.
Oh, yeah.
Right, a lot of macroeconomics, a lot of fundamental analysis, a lot of, historical trends, Elliott wave.
Yep.
There's a lot of tools you guys see us use. It's not just, first of all, the stack that we use in the public podcast is not the full stack of things that we use. Right. So just to be transparent there, this is a member who probably knows a lot more about some of the other things that we use because it's in the newsletter and we talk about it and we get into detail, because our whole point is to educate people through this public podcast, and also members we go deeper, right? And we do daily and weekly and decade, and there's lots of perspective, and we use other not just indicators but other things besides just those 4 funds, right? A lot going on. And so you didn't even mention, like in TradingView, there's 200 indicators, right? Stock chart says 50, right? So it's 200. So it's not really about finding one that's sensitive enough to do X, Y, and Z, which I know you're going to get into here. So I'll let you do that.
Yeah, so I just, I'm not going to get into the whole stack and all, but I just wanted to look at a couple of different moving averages. So this is a weekly chart. Okay, so if you are following along on a weekly basis, you're trying to pick a moving average that supports price so that you don't keep getting whipsawed in and out. So it's weekly. The red is a 5-week moving average. The blue is 20-week, which is what we use, on the charts at the end. And then the 50-week is in green. So the interesting thing, if you put a bunch of moving average lines up there, is the nodes. Like when you have the 50-week, and then the 20-week above that, and then the 5-week above that, you're in an uptrend. If it's reversed, you're in a downtrend. So overlaying multiple moving averages is kind of helpful. But the thing I wanted to point out, the 50-week moves so slow compared to the 20 and the 5 that once it starts turning positive, it's going to stay in that direction even if price does some pretty big swings. So if we're using a 50-week moving average line here, once you got back above it right here, you would have stayed in the market until this week right there because you were still above it. So if you're using a 20-week, we don't have the rest of the stack here, so this would have been an example of a week you might have gotten out because it was below the 20-week, the blue line. Other than that, you wouldn't have gotten out until this week. So it's much more sensitive, and it only gave you that one whipsaw right here on a weekly basis for that whole bull market in 2020 into 2021. If you try to get more sensitive, right, and we say the 5-week moving average line. So the 5-week is in red. We got above it here, got below it here, and then back above it here. So you would have been out this week, back in on this week, out on this week, back in on this week, out here, in here. Out, in. You'd have done much, much more reallocating. And so obviously a 5-week moving average line is too sensitive, right? It's going to get you in and out much more than you are able to do in TSP. And so that's why you can, it doesn't have to be a round number. You can use a 12-week or 16-week moving average. You can do whatever works, but I've just found that the 20-week seems to work pretty well for catching the majority of the gains and avoiding the majority of the downside on a weekly basis. If you look at it daily, so doing the exact same thing but daily, the red line again is the 5-day moving average line. So you can see, if you're looking at a daily chart, you're out here, you're in here, out, in, like for this 4 days in a row, you're going in both directions. So the 5-day, you can't use it on a daily chart. The 20-day is the blue line, right? 20-day you can get whipsawed also. If you're just using the moving average line, you got out here, you got in here, you got out here, you got in here, you got out here. There's a lot of, when the market in general is going sideways, it's really hard to avoid those whipsaws anyway. but the longer term moving averages can keep you in during a consolidation. If it comes out the other side, it's going higher, you're better off than you would have been. So all I can say is just play with it. Pick the moving average line that kind of makes sense for you and your time frame. But there's definitely no one stack or one moving average line that works in every market. So the 50-day is a pretty important one. Once we get, moving, you expect to get support at that 50-day moving average line. And this was a big one right here where we lost support at that 50-day. It doesn't mean that it necessarily derailed this bull market, but this was a big one when we lost the 50-day last week. All right. So basically, you want to pick a strategy and stick to it, right? So I'm just going to go over basically the 5 strategies that I think the majority of people use to manage their TSP. So you have L funds, buy and hold, swing trading, seasonality trading, and what we do is trend trading. Okay, they all have pros and cons. Some work better than others depending on the market. So our job is to pick a method that speaks to us, that we understand, and that fits our personal circumstances and risk tolerance. There is no one best strategy for every market. When the market's going up over a long period of time, buy and hold is the best thing you can do because the market just keeps going up. But when the market's going sideways or obviously down, buy and hold doesn't do as well. Okay, so there's no one method that works best in all markets, overall time periods. The key is to get very good at executing whatever strategy works best for you, right? And then stick to that strategy. So the L funds work on this pretty simple theory that stocks are generally riskier than bonds, okay? The idea is to pick the L fund that corresponds to the approximate year in which you intend to retire or the year that you actually need to use the money. So some people stay in the furthest out L fund because it gives you the most exposure to stocks. But the whole point of the L fund is that it reallocates every quarter to decrease your exposure to stock funds and increase your exposure to the F&G funds, because the idea of it is that stocks are theoretically more risky than bonds. So as you get further along in your career and you get into retirement, according to the L fund theory, you don't want to be exposed to the stock funds because they're riskier than bonds. So that's how the methodology works. It's completely indifferent to the ups and downs of the market, right? It's only based on your age, basically, because it reallocates every quarter, decreasing your exposure to stocks, and that stocks are riskier than bonds. So if that methodology makes sense to you and fits your personal circumstances and risk tolerance, it's a good choice. You set it and forget it, and you never have to look at it again. Okay, buy and hold works on this idea that the market always goes up, right? And if you look at a 100-year chart, yes, over the last 100 years, the market has gone up. There's no doubt about it. There's been some big drawdowns in there, but the market over the last 100 years has certainly gone up and to the right. I mean, no doubt about it. So with the buy and hold, you would allocate 100% of your TSP funds into some combination of the stock funds, right? CS&I. A lot of people that haven't been around for a while don't give the I fund the sort of the respect that it deserves, but the I fund will sneak back up on us at some point and start to outperform the C and the S. But a lot of people just say 50-50 C and S and leave it there. So like the L fund, this method is completely indifferent to the ups and downs of the market. If it makes sense to you and fits your personal circumstances and risk tolerance, it's a great choice. Swing trading. It's an active form of a way to manage your TSP. The idea is you reallocate between the funds to reach a certain target profit. So say you want to make 10%, you reallocate to the C fund when price is, let's say, $10, right? You would reallocate back to the G fund when price hits $11 because you just made your 10% profit, right? That would lock in your 10% gain, and then you'd wait for a favorable setup like a pullback, and then do it again, right? That's how the swing trading methodology works. It's an active form of TSP management, right? It is completely dependent on the ups and downs of the market. That's what it has nothing to do with whether stocks or bonds are more risky or your age or where you are in your career. It's completely dependent on the ups and downs of the market. If the market's going sideways, it's very tough to be a swing trader. If it's going straight up, it's also very tough because if you're not getting pullbacks to do a reset, it's a difficult environment to be a swing trader. Takes practice for sure to get good at it, and you have to be able to watch the market pretty closely. But if this method makes sense to you and fits your personal circumstances and risk tolerance, it's a great choice. Seasonality. There's a lot of talk about seasonality trading. It's based on the idea that stock funds tend to perform better or worse during certain times of the year. It's based on historical analysis of price movement, right? I mean, we've done it before on the show. We've done it a lot in the newsletters. That famous adage, sell in May and go away and come back after Labor Day. That's a seasonal kind of reallocation method. You would be in the stock funds from October through the end of April, and to be in the G fund from May through the end of September. Methods based on historical price movement, right? It's independent of what's actually happening at the time. So, there are times when there are years when the seasonality doesn't work, and you're betting on the odds, right? If the odds are that these months underperform, then you don't be in the stock funds during the months that underperform. But it doesn't mean that that's what's going to happen this year. And then what we do is trend trading. It's a form of active TSP management, utilizes price charts and technical analysis tools to identify significant market tops and bottoms. The goal is to reallocate into the stock funds when a bottom in price has been established, and then reallocate to the G fund when a top in price has been established. This method is completely dependent on the ups and downs of the market. The bigger the swings, the better you do in trend trading. You want the trend to be moving for a long time, whether up or down, doesn't matter. It takes practice, and you have to watch the markets closely. And if this methodology makes sense and fits your personal circumstances and risk tolerance, it's a good choice. So there could be others, right? These are the 5 core methods basically that I think most people use. They all have their pros and cons. None of them work 100% of the time. L funds and buy and hold don't do very well during protracted market declines, right? Obviously, people that were buy and hold had big losses in 2000 to 2003, 2007 to 2009, and most recently in 2022. Swing trading and trend trading don't do very well during periods of like long-term sideways market movement. And then seasonality doesn't do very well if you have a rally in the summer, right? If you sell in May and go away and the stock market rallies during the summer, you're not in it. And then if you have big market declines in the winter when you are in the stock funds, that's not good either. So none of them work 100% of the time. But the worst thing you can do is to constantly switch between methods, right? If you're chasing what seems to work best at the time, that basically guarantees you're going to have poor long-term performance. So pick a method that makes sense to you, works with your personal circumstances and risk tolerance, and get really good at employing it and stick to that method. We see like questions all the time about I should have done this and I should have done that. None of these work 100% of the time.
Yeah, they definitely won't work if you only do them for short periods of time. Yeah. I would argue you need at least a year, and really, if you look at the market over time, you probably need 2 or 3 years to really see, does this method work for me? Does it make me sleep at night better? Does it give me decent enough performance? All that. Like if you're back and forth all the time, you're never going to know. And you're always going to be, well, first of all, you're going to be working off emotion. That's it.
Yeah.
Right. You're going to be working off emotion, not data, because you don't have any data because you didn't do it long enough to figure out.
Yeah.
And so it really comes down to picking a strategy that works for you, sticking with it, one that speaks to you and one that you feel comfortable about. Right.
Yep.
And it's not always going to perform well.
No, definitely not.
We're very clear about that. Our methodology fares better when there are big downs and ups of the market, right? We need pretty big drawdowns and recoveries to happen for it to play out in our favor.
Right, so that you can identify the tops and bottoms.
Because you got to see them. Yeah. If you got a lot of this, what we have right now, which is when this is all said and done, and we go back and look at this at a 5-year chart, this time period right now, it'll be almost a straight line. I mean, it'll be a cross.
Right.
That's what I mean, right? So it's going to be a correction like this. It's not going to be something that looks like this, right? Right now it isn't. And so that's a very hard market for any methodology. Yeah. Right, particularly ours, because we only have 2 moves a month. We can't be in and out. And then what else would you do, right? So if not that, then like you said, okay, I'm gonna be a seasonal person. Okay, great. Then you're not even in. You're you're either in or you're out, and you don't really care about what the market's doing.
That's right.
And certainly, if you're buy and hold, you shouldn't care what the market's doing because you're not doing it. You're not actively managing it. So. Anyway, I mean, I tend to tell people that we do a combination of those. We take into consideration
for sure
seasonal.
Yep.
We take into consideration macroeconomics, things that are happening in the world. But at the end of the day, the price is the only thing that matters.
Yeah.
And so that's what we have to make our decision off of. It's nice to know all those other things, but at the end of the day, the price is the price, and that's what it is, and it's either below a moving average or above a moving average.
Yeah.
But if that doesn't speak to you, then it doesn't matter, right? If that doesn't resonate with you,
right? I mean, so a lot of times, anything in social media, people are either bashing what didn't work, or they're beating their chest about what did work.
Yeah.
Right. And so, since none of these work 100% of the time, there's always going to be that.
Right.
There's always going to be people that are like, I should have been in seasonal because, the guys that are in seasonal made a, are up for the last quarter or whatever.
And then next year it'll be different.
It'll be different. Yeah.
Yeah. Just find one, pick it, whether it's ours or someone else's, stick with it for a while. You got to let it play out, and we would argue you got to do something. Passive investing is a scary thing to do with your retirement.
Passive investing in this market environment is very dangerous right now. Yeah.
Yeah.
All right. So bonus chart, dollar versus the F fund. So we've done a bunch of this, but this week was pretty important, and so I just wanted to point it out. So in general, this is a chart of the dollar, and this is a chart of the I fund. Okay. So when the dollar is moving higher, the I fund is going down. When the dollar comes down, the I fund goes up. Okay. So what's happened over the last few months is the dollar is in this consolidation channel, right? Depending on where you want to draw this line, to be fully transparent, this is how I drew it. This breakdown through that lower channel line was a serious head fake for the dollar, and because the idea is that you have a trend which is down, you have a consolidation, and ordinarily the consolidation pattern resolves in the direction of the prior trend. And the prior trend in this case was down. So you'd expect a down move, a consolidation, and then another down move. That's generally how it works. So it was pretty exciting actually, because when the dollar goes down, the I fund goes up, right? So this break of that line here was a good indication that stocks keep moving higher. But that's not what happened. It took a week and a half for the dollar to turn back around and start moving higher. And when the dollar goes higher, iFund goes down. So why I'm showing this right now is because of this black line. So that was a top channel line. And this is a weekly chart. And so as of Thursday's close, we're at 104 on the dollar. RSI is now above 50 and MACD crossed to the upside. So it looks like the dollar is going to continue to move higher. And if the dollar continues to move higher, the iFund specifically, but the stock funds in general are going to move down. So I'm watching the dollar really closely, and this setup on the dollar right here is not good for stocks. All right. Weekly TSP fund charts. So this is a 20-week moving average line. This is a piece of the stack that we use. 20-week moving average line, relative strength indicator, and the MACD. Okay. So if you're looking at it on a weekly basis, once price gets above that 20-week moving average line, RSI is above 50, and MACD crosses to the upside, it's a buy trigger, right? This was the one we were talking about earlier. RSI never got below 50. MACD did turn negative that week, but RSI did not get below 50, so we did not have a sell trigger based on the stack. So we would not have gotten out on that week. And then it turned right back around and kept on going. So we didn't actually get a sell trigger until that week in January. You got price pretty drastically below the 20-week moving average line. RSI got below 50, and MACD had already turned negative. So where we are right now, it's a big reversal week, okay? But we don't have a sell trigger. So if this bull market that we've had since the October low of last year, if it's going to stay, if it's going to continue to go higher, we should expect it will act something like this bull market, and it'll get support at that 20-week moving average line. So this is a really important test right here. Okay, if it holds, if support holds, and price keeps moving higher, that's great. If we get a weekly close below that moving average line, and the indicators all turn negative, it's very likely that price moves down for some amount of time, right? Then we're looking at, do we get support at this low, or are we going to go back and retest the lows from last October? So those are the things you're looking at on a weekly basis. We're at a pretty critical juncture right now, which gives you opportunity, actually. And it gives you a really good line in the sand. To get down there, we had to take this much of a drawdown. But now we're there. So we have a pretty good opportunity right now. Okay. S fund. Kind of similar to the C fund, I guess. I mean, where it's worse, but it is right on that line. And it's been trying to find support and has found support for the last 2 weeks right on that line. RSI is 50.83, just barely still positive, and MACD is just about to turn down. So we don't have a sell trigger yet. It's right on that line, and it's entirely possible that price gets support there and keeps moving higher. It's also possible if it breaks below there, it goes to the downside. iFund, last week, we got a sell trigger. We got a weekly close below that 20-week moving average line. RSI had gotten below 50, and MACD was already negative. So iFund is not looking very good right now, and it shouldn't be a surprise because it's consistent with the dollar breaking out to the upside is consistent with the iFund breaking down to the downside. And the F fund, if you're a subscriber, we did a whole newsletter last week about the TLT, the F fund. VLGSX is a ticker symbol you can use in the mutual fund window. So the gist of it is this. This was the high for the F fund back in 2020. We came down in a 1, 2, 3, 4, and we're in this 5th wave down of an Elliott wave cycle. So when we get to the bottom, all it has to do is get below the 3. Theoretically, if the length of 1 is the same as the length of 5, you'll get down here to somewhere around 90. If we get down there, it'll be a great buying opportunity for the F fund. If we get down there and the Fed has broken something in the economy, they start dropping rates really fast, stocks should tank, and the safety of bonds should move the F fund higher. The biggest moves in bonds will be long-term treasury bonds, and the F fund has some of them. It also has corporate bonds and municipals. It's the aggregate bond index, so it won't move as much to the upside as VLGSX is the ticker symbol for the long-term treasury bond in the mutual fund window. So that would be a better. You get more performance in there than you will in the F fund. But if this plays out this way, the F fund is going to be the only place to be in the TSP core funds. The G fund will have, whatever the rate of return is for the G fund, which will be decreasing as the Fed lowers rates, because the rate of return of the G fund is the actual yield. So if the Fed starts lowering rates, the return you're going to get on the G fund is going to decrease. But in this case, the F fund will go up quite a lot. All right. I feel like that was a pretty quick one.
Questions.
But, questions.
Yeah, it was relatively quick. I let you talk.
All right.
But it was good stuff. I think a lot of good, important takeaways. Definitely those 5 strategies. We shared that on the Facebook group that we have. We sent it out in a newsletter to everybody that signs up for our newsletter, not just the members. So anyway, if you're interested, you can find it in those places, and you can also go back and watch this again. But that is really, those are really the options you have.
Yeah.
Right. Maybe there's 1 or 2 out there that we've missed that might make it as a methodology, but probably it's just a version of one of those. Right.
Yeah.
And at the end of the day, so find what works for you.
Yep.
Follow it, and accept that it's not always going to work perfectly.
Yep. And
do your best not to be emotional about it, because you can only do so much. You can't control the market.
Yep.
And keep watching the show.
Yeah, that's all you can do.
Because the stuff we talk about here, nobody else really that we know of is talking about how it is relative to the TSP.
Yeah.
Right? And so we're going to try to give you as much insight as we can to that, and then find the methodology that works for you. And between those things, you should be able to manage your retirement account.
Yeah, and not managing it is an option too, right?
Exactly.
It's just that, if you're buy and hold in the G fund, that's an option too. Like if you're retired and you don't want to take any drawdowns,
go to the G fund.
Go to the G fund, and you're getting
or roll it over to an IRA and let a person manage it.
You could do that.
That's usually what I don't want to say recommend, but that seems like a reasonable option. If you're into retirement, you still kind of want to make it work for you, but you don't want to manage it, fine. Roll over, even roll over a portion of it or something, right? That you get into an IRA, let a money manager manage it for you, and get the best out of it that they can. They can't manage the TSP for you.
Not while you're in the TSP.
And they're not gonna. Yeah. That's right. Yeah. All right, guys. Hope you enjoyed the show. If you like it, share it with your friends. If you didn't like it,
definitely share it with friends.
Definitely share it with your friends. And if you have any comments or questions, you can shoot them to us at support@growmytsp.com or in the comments section wherever you find this video. All right, guys.
All right.
Have a great
good weekend.
Do-do-do-do-do.